Hey everyone, welcome back to Ponzi Scheme Investments. Today, we're diving deep into Amazon's latest stock plunge, examining why it happened and what it means for the future. Spoiler alert, there might be more downside ahead. Make sure to stick around until the end because we'll be discussing a potential silver lining for Amazon that you won't want to miss. But first, if you're new here, don't forget to hit that subscribe button and click the bell icon so you never miss an update. Alright, let's get into it. Amazon's Q2 earnings report. Amazon recently released its Q2 earnings report, and the results were a mixed bag. On one hand, the company reported earnings per share, EPS, of $1.26, which was 23 cents ahead of Wall Street estimates. That's nearly double the 65 cents EPS from the same quarter last year. Revenue came in at $148 billion, up 10.2% year over year, but it missed the consensus estimate by $760 million. While Amazon has benefited from cost-saving measures and easing supply chain disruptions, the revenue miss highlights some concerns about slowing consumer demand. The timing couldn't be worse, as the market is already jittery due to poor economic indicators. Amazon stock has dropped about 18% from its 52-week high. Retail segment concerns. One of the main concerns is Amazon's retail business. The North America segment, which includes core retail operations and services like Amazon Prime, grew by 9%. While that sounds decent, it's notably below the double-digit growth range we've seen in the past. During the earnings call, management pointed out that customers are becoming more cautious with their spending, particularly on large purchases. This suggests that consumer spending conditions are weakening, a poor sign given the challenging macro environment with high interest rates and a loosening labor market. AWS, a bright spot. On the flip side, Amazon Web Services, AWS, has been a strong performer. AWS revenue grew by 19% year over year, driven by ongoing demand for cloud services and new AI opportunities. However, even this bright spot comes with its own set of questions. Is this growth sustainable, or are we nearing the peak of this cycle? Macro volatility and economic indicators. The broader economic picture is also concerning. The U.S. recently reported weaker-than-expected job growth, adding only 114,000 jobs in July compared to the 175,000 estimate. Prior months were also revised lower, and the unemployment rate has climbed to 4.3%. With more than 2 years of elevated inflation and high interest rates, the economy appears to be slowing down. The Federal Reserve's reluctance to cut rates adds another layer of uncertainty. All of this spells trouble for Amazon, which is highly sensitive to consumer spending and economic sentiment. Valuation concerns. Given these headwinds, Amazon's stock could see further downside. Current forecasts for Amazon's growth and earnings into 2025 and beyond seem overly optimistic. If the economy continues to weaken, Wall Street will likely revise its estimates lower. Amazon stock is currently trading around $160 with a forward P/E ratio of 28x. If we assume a modest 10% haircut to the EPS estimate for 2025, this would imply a price target of around $131. In a worst-case scenario, the stock could fall even further. Our bearish view. We rate Amazon as a sell. The current macroeconomic weakness is just beginning, and we expect Amazon to trade lower over the next year. However, for patient investors, this could present a more attractive entry point down the line. Potential silver lining. Now, as promised, let's talk about that potential silver lining. If economic conditions improve and the Federal Reserve cuts rates, we could see a rebound in consumer spending and credit growth. This would be positive for Amazon. If the company can decisively beat top and bottom line expectations in the next few quarters, we might reassess our bearish stance. And that's a wrap. Thanks for sticking around until the end. Don't forget to like, comment, and subscribe to Ponzi Scheme Investments for more insights on the stock market. See you in the next video.